As American ethanol plants come back online, producers may find a steep grade slowing their return to pre-pandemic production levels. Restarting the 35% of ethanol production that is still idled will require the American consumer returning to their 2019 driving habits. But changing work routines could be a long-term drag on gasoline sales. Dan Brazzi is a consultant with Ag Resource, a Chicago, Illinois-based financial risk management company.
Or if America changed its driving habits because of homestay, there's a lot of corporations in my town in Chicago where people are going to continue working from home. They won't make that commute into Chicago. That's something that will longer term have a structural impact on U.S. energy consumption, which thereby affects ethanol consumption.
According to the U.S. Energy Information Administration, gasoline consumption peaked in the summer of 2016 and was down 8% before the economy was upended by COVID-19 lockdowns. Reduced driving may also affect the math of the renewable fuel standard.
But as we think of ethanol, the U.S. ethanol mandates that are set each year by the EPA are directed upon miles driven in America. So if we Americans drive fewer miles, the 15 billion gallon mandate will come down.
Returning ethanol production to its 16 billion gallon peak will require an increase in exports. While export volumes rose from 10 million barrels to 40 million barrels between 2010 and 2018, exports represent less than 10% of U.S. ethanol production.
I think residual production, as I call it, stuff that's not used domestically, will have to be exported.
Slow growth in ethanol production will be welcomed by the corn market, but a healthy corn crop will increase stocks and potentially depress prices.
Well, I think the farmer needs to think forward. I mean, as we look at where corn prices and soybean and wheat prices are today, I hate to say it, but there's still more downside risk, even with the ethanol industry in this recovery mode.
From Market to Market, I'm Peter Tubbs.